Welcome to video 7-2. Here we're going to get into the cost variances. So we have three different general inputs we're talking about: direct materials, direct labor, and overhead. And each one of those can be broken down into a price and a quantity variance. And on top of that, we also have the volume variances, which is a whole separate issue that we get into with the cost side that we didn't get into with the revenue side. And then at the end of the video, we're going to go to, I think it's section 7.8. Yeah, 7.8, where we talk about mix and yield variances, which occur both in revenue and in the cost side. It's where you break down the quantity variance into a mix and a yield variance. Let's focus right now on what we're doing with the cost variances. So, first of all, there are a couple different things that change. One, we kind of have two different flexible budgets when we're talking about cost variances, because we have two different units that are operating. What do we mean by units when we're talking about costs? We could either mean total finished goods units that we produce, or we could mean units of input that we put into the process to create those finished goods units. So let's say we're talking about direct materials. Let's say we are a producer. We build workout benches, and so a number of different direct materials go into that. We have metal, upholstery. Let's just talk about just those. Let's just say those are it for simplicity. We have some upholstery on the bench to make sure it's comfortable and durable, but metal to keep it structurally sound, because it's a workout bench, so people are going to be a lot of weight is going to be moving on it. Right. Well, let's say we have those units of input. We have how much metal we put into the workout benches that we produce this period. We have how much upholstery we put into the workout benches this period. That's a separate unit value compared to the number of finished goods units that we produce. If let's say we have really cruddy upholstery one period, I don't know, the purchasing manager, instead of going to find reputable sources, he went out to the back alley and found somebody, in a big trench coat with upholstery on the inside of the trench coat, saying, "Hey, you want to buy some quality upholstery?" Because that happens, right? So let's say he did that, got some garbage upholstery, and we put in twice as much upholstery into the system as we usually do, because it just kept falling apart on us as we produced the materials. So we put in twice as many yards of upholstery to get the same number of finished goods units. That's a separate, the quantity of the input is separate from the quantity of finished goods. And so we end up going down here and we say, look, we have to discern between differences in the units of input and differences in the unit of output, differences in the unit of finished goods. So we predicted a certain number of units to be produced last period, a number of finished goods units to be produced last period, and we combined that with a prediction also of how many units of input we're going to produce. Those are two separate predictions. We're going to need to produce a volume variance for our differences in our units of finished goods that we produce, and a quantity variance for differences in the quantity of input that we produce. We didn't have that issue with revenue. To get a unit of sales, you sell a unit of goods. It's 1-to-1. But with cost variances, we're going to need to discern the two. And so I have a table right here. And in this table, we use these two different budgets we're talking about. The static budget is based on last period's budgeted volume of finished goods units. We're talking about finished goods units when I use the word volume in this case. Flexible budget is talking about the budget based on the actual volume. So we're using all the same assumptions as the static budget, but we're just plugging in actual volume from this period. So it's standard quantity, standard price, but actual volume. So this is it right here. This is an example of it in this table. We have the static budget used the volume right here. This is the flexible budget volume, the actual volume. Everything else in the flexible budget, is the same, uses the same standard price and quantity for revenue, materials, labor, overhead, and the variable portion of SG&A. And just multiplies them by a different number of units produced. And this is the typical pattern, is you see revenue has a positive, when there's more produced and sold than you expected in the static budget, you're going to have a favorable revenue volume variance. And when there's less, you'll have an unfavorable revenue volume variance. And the opposite is true for materials and labor and overhead, all the inputs, and any variable portion of SG&A if you use that. Your flexible budget will show that actually those costs go up if your volume goes up, Well, naturally, you have some variable costs in there, and if you're going to produce more finished goods, you would expect to use more variable costs. That's not bad. A lot of businesses would kill for that. They really want extra volume. So that does mean doing extra variable costs. Okay, so this is our volume variance, and it's strictly on moving from the static budget to the flexible budget, just by taking units from the volume of finished goods units sold and produced from last period's expectation in the static budget to the actual amount that we observe. I like to joke sometimes in class that it's almost as if you have a time machine, and the most important use you can find for that time machine, because you're weird like me, I guess, I don't know, is to go back and whisper to yourself, actual units this period is going to be 110. And if you had done that, what you would have budgeted at the static budget. That's what the flexible budget is. That's all it is you have this time machine in which you did this stupid thing. So, here we go. For cost analysis, budgeted quantity that we're talking about is always drawn from the flexible budget, not the static budget. I say that because here's the reason why I have this rule of thumb. When we're talking about our cost variances, we are primarily interested in these two right here. The volume variance really, as far as costs are concerned, isn't terribly important. I'll be honest, because I expressed already what it means. It means naturally, if we sell more, we have higher volume, we're going to have more variable costs. What does that really do anything for us as far as changing our procedures and our actions? Not really. At least if it does, it's fairly simple. It's fairly straightforward, or perhaps a longer term kind of change that we have to make. So we focus more of our attention on the quantity variance and the price variance. And so when I say budgeted quantity, I mean it with the asterisk here. So I'm always talking about from the flexible budget. That is the budgeted quantity of whatever the input is we're talking about. We're always doing one input at a time, of direct materials in one instance perhaps, at the standard quantity of direct materials per finished goods unit, at the actual finished goods units produced and sold. So it's budgeted, but there is a slightly actual component to it. It is slightly more actual. This is why this is slightly more to the left of the static budget. The static budget is entirely budgeted. We know this before the period starts. We don't know this until after the end of the period, but we don't have to figure out we don't need to know any of the actual quantity of materials we used per finished good unit, and we don't need to know the actual price we used. So this is our again, I'll say it again. This is our budgeted quantity at the standard quantity per finished goods units for the actual number of finished goods that we produced. So we've taken the variance here and split it into two. Well, the volume variance, as we understood it up here, we split it into two because there are two possible reasons why you used more quantity of a particular input. Perhaps we used more direct materials because we just sold more. We just produced and sold more and had higher volume, and so naturally had to have some increased direct materials just to produce those finished goods. And not that you were particularly wasteful, but you had to have more. And so now we can separate out how much of our input is due to a volume variance because we just increased the volume of finished goods versus how much of it is due to mismanagement or good management of the particular input that we're talking about. Okay, so that allows us to have this. And I have two different budgeted quantities to talk about. And I say up here, maybe I'm a little too strong with this always, but I say up here that the budgeted quantity is always from the flexible budget, not the static budget, because we're most interested in this one right here. This is what we can use to say, hey, you did a good job. That's a good quantity variance. Production manager, usually is the person who manages the factory. Good quantity variance there. You get a raise or promotion, or we want to know what you did so you can go tell the other branches. Or we can say, you know what, that quantity variance is really bad. What happened? Did Michael get on the forklift again? You know, what exactly? Why is there such a quantity variance over here? So let's talk about direct labor variances. We're just going to talk about the quantity and then the price variance. Not even worry about the volume variance at this point. Really, like I said, this is a function of the overall volume that we were driving, and it's as much a responsibility of the corporate governance and the sales force as anything else. So we want to focus on controlling costs. We are looking at the quantity, how effective we are with the inputs that we are we efficient or not? And the price, are we getting good deals from our upstream suppliers? All right, labor quantity variance is going to work the same way as we thought before. We have the more actual number minus the more budgeted number. Actual direct labor hours used to produce the number, the actual finished goods produced, times the budgeted price, minus what we would have budgeted in direct labor hours for the actual finished goods produced, times the budgeted price. So the only thing we're moving here is this quantity. And again, this is the flexible budget quantity. We're talking about how many direct labor hours we would need, we would have budgeted to produce the actual number of finished goods units over there. We've already trued up from the static budget, which projected a certain number of direct labor hours for the static budget number of volume, to the flexible budget, which says how many direct labor hours we would have budgeted if we knew about our true volume at the actual volume. Okay, that gives us the direct labor quantity variance. That's this flexible budget, that's this what I call quasi budget minus the flexible budget. I just need a different name for a flexible budget. It's another type of flexible budget, really. So this one is now, the flexible budget here is the static budget with that one cell replaced. It's the same as the static budget, same functions are in these cells as are in these cells, but I've changed one cell. Now, the quasi-budget, as I'm calling it, I'm taking the quantity and making that into the actual quantity used. So it still has some elements of the static budget. We have the standard price, the budgeted price still here, but it's not quite full actual. So I'm just going to call it the quasi-budget for my purposes here. We get the difference between those two, and we get the quantity variance. So direct labor quantity variance, we can also arrange it algebraically to have just the difference between the hours that were used to produce those actual finished goods, all times the budgeted or standard price. So an unfavorable quantity variance suggests we're spending more time per finished goods unit than we would have expected, than is the standard. Perhaps our people don't know their jobs well enough, or their jobs have changed. This could be because of poor retention. Oftentimes, if you have bad management policies, it'll show up here within a short order because the management policies will drive the skilled workers out. They have mobility. They can update their resume and get another job somewhere else that's not toxic. And so we then have higher turnover, poor retention of our employees, and therefore their skill level on average has reduced. And so they just take longer to do the job. So now we have the beginnings of how we can narrow down the actions that we can take. Again, when I say above when I said in the last video that it has to be actionable, that doesn't mean necessarily that it lays on a silver platter for us exactly what we need to do, but it gives us at least a small set of possible problems that we can solve and improve upon. And it doesn't take much digging beyond that to find out which of those is a primary driver or which ones are primary driver if there are multiple things driving the variance. So yeah, this is one option. We don't train them well enough, or their job has just become more complex than we expected. We have poor retention for some reason that's also effectively reducing the training level of our average employee because the good ones are leaving, and or we just have newer employees because the average tenure of the employees has reduced. It could be they have low quality materials. So here we have a material problem which is affecting direct labor. So with just a little investigation, we can create a plan of action to improve this variance, or to maintain, if it were favorable, to maintain a good variance. So let's say it's favorable. Maybe that's because we have a higher skilled workforce than we thought. Maybe we have some just stellar managers that our employees don't want to leave. They like the workplace. They like being there. Or maybe we have some really high quality materials that they don't have to rework all the time. And so therefore we're getting more out of their labor as far as in terms of finished goods that are produced. And then we can investigate which of those is the case, and we can develop relatively easily develop an action plan about how to maintain that positive variance and maybe even increase it over the future. Let's do a really quick example of this. Let's just go ahead and say we're looking for a DL quantity variance. And we're going to calculate it out because we need some standard quantities and standard prices and actual quantity. Standard price is also budgeted price, standard quantity, budgeted quantity. Now let's just go ahead and say we produced 1,000 finished goods. We expected 800. This is our actual finished goods completed. This is our static budget finished goods completed. You can bet that some sneaky professor is going to include this number right here and hope you use it instead. But I told you need to use the actual volume. This is volume. These are volume numbers of finished goods to get the standard quantity of this input. We're talking about direct labor, so it's direct labor hours. Now let's just go ahead and say that there are 2 direct labor hours. Let's make that a separate cell. 2 DL hours per finished goods unit. And so in the static budget, there were a total. The standard quantity typically is referring to the total. This is the static budget's standard quantity right here. 1,600 direct labor hours expected because there are 2 direct labor hours per finished goods unit. We expected in the static budget, when we budgeted last year, to complete 800 finished goods units. So we budgeted 1,600. We really don't care about that when we're doing the quantity variance. It would be important for the volume variance, but make sure you don't use that number. Flexible budget, standard quantity here, is going to be that same standard of direct labor hours per finished goods unit times the actual finished goods units. So 2,000 is the standard quantity that we would expect in terms of direct labor hours. So we're going to go ahead, I'm going to go ahead and make sure I gray this out. We don't use that. We don't use that. Make sure you do use this and this. And this is a standard. It is the standard quantity per finished goods unit, but you want to get that into total direct labor hours you would expect given the volume of finished goods units that we had during that period. And that's the standard quantity that you need to use for these equations. Let's go ahead and just say the standard price is $25 per hour for direct labor. Okay, now you can multiply those out. And so our flexible budget for direct labor was $50,000. If we had that time machine and we whispered into our own ear that, hey, volume's not going to be 800, it's actually going to be 1,000, because that's the most valuable thing you could do with the time machine is tell yourself what actual volume is going to be. Then we would have budgeted $50,000 for our direct labor because we expect $25 per direct labor hour, and we now know that there are going to be 1,000 actual units produced. But we did not actually have 2,000 as our flexible budget. We could. If we did, we'd have a 0 variance. We have no variance. But let's just say, for sake of argument, we actually used 2,500 direct labor hours. And so let's try not to get this confusing. I'll put it over here. Because if I put it right here, I worry that somebody's going to see this and say, oh, this is in the same column as this, so this is, he's expressing flexible budget. No, actual quantity over here. So 2,500. Now we can multiply this out as well, and so let's just do. We don't need that number at all. We could multiply this out and say, how do I want to organize this? I'll get the big numbers in a minute. Multiply that out in a minute. So right now, let's just algebraically say, we need actual first. AQ minus SQ all times SP, standard price. That's what the equation says right here. Actual quantity minus standard quantity times that difference times the standard price. Okay, now if we do that, we take actual quantity less standard flexible budget quantity. We could either push F2 to edit the cell or click up here in the formula field and then multiply that by that difference, have to put in parentheses, there, multiply that by our standard price. We have a difference in dollar amount now of $12,500. So the 500 unit difference, the 500 direct labor hour difference here multiplied by the price per labor hour gives us a quantity variance of 12,500. So we have a, this is unfavorable because it's cost variance and it's positive when we did our difference here. Also, I look at it and I say, well, we used more direct labor hours than we should have to produce 1,000 units. So that's unfavorable. And we have a dollar amount on those labor hours. Now, we can also look at it in terms of right here. We can build these squares too. All I did is I calculated the square by taking these 4 italicized items. Well, this budgeted prices in both of them, so there are actually only 3 separate italicized items right here: AQ, SQ, and SP. But I can also go ahead and actually build each of these squares, which I started to do. Right here, that $50,000 sale that I was debating what I should do with, that's this right here. And so we can just build ourselves label it just how I have in the textbook here. We can build this and say, well, this one is going to be our actual quantity times our this is going to equal our actual quantity times our standard price, and this is going to equal our flexible budget standard quantity, our budgeted quantity, standard quantity, times the standard price. And then this is going to simply equal the difference between these two. Okay, and if we drew a line right here and put boxes around these, it would look exactly like the textbook example. And so this is all we're doing. We just did the same thing over here as if we drew out a diagram. If it helps you draw the diagram, please, more power to you, draw the diagram. Okay, with direct labor price variance, again, we're now going to take the quasi-budget and subtract it away from the actual, full actuals. And so the only thing we're moving here is the price. Everything is at actual quantity of the input, the actual quantity of direct labor used in both situations. And now we have the actual price per direct labor unit, which is usually hour, minus the budgeted price per direct labor hour. And so that's right here. We have actual quantity, actual DL hours, times the actual price, minus the actual quantity times the budgeted price. So again, we can pull out the actual DL hours out there outside the parentheses, and we have just in the parentheses the difference in price between actual and budgeted, just multiplied by DL hours. Now, if this is unfavorable, there are a few different ways that this can be the case. One, actually, I'm surprised how many people don't anticipate what this means. They assume that it means that the labor market in general has changed. And that is definitely one possibility. Perhaps there's additional competition from adjacent industries or companies, and so therefore there are fewer workers. For example, here in Idaho, it's actually one of the reasons why homes get delayed when they're being built, or their prices go up more than they otherwise would have, is that other homes are being built too. That the growth is driving competition, and so we have a limited number of workers who have especially certain particularly skilled jobs that they have to do to build these houses. And so sometimes you just have too few workers during the busy seasons of house construction. And so you have other companies out there, other industries even that are adjacent to your industry that can affect the labor market and therefore drive the price that you have to pay people to get them out to work for you up. It could be also, if there's something going on, like I said up here, that's why I drifted up there. Like I said up here, if there's some sort of an atmospheric thing, in order to keep people on, if there's, let's say it's a not as positive environment as possible, or there are additional risks now. Let's say suddenly a large part of your company is in an area that has a different country, and that country has become much more dangerous. So, well, you know what? People are not going to stay with the company and stay in that area without some additional inducement. So you're likely going to have to throw extra money at them. You're going to have to increase the price that you pay them for them to stay there. Also, what I started to say, but then I stopped myself. I often do that. I'm sorry if that annoys you. But what I was starting to say is this overtime business actually is one of the interesting things that happens. If you have bad management of your employees and you don't either get the right people involved or don't hire enough people or whatever the case may be, that's driving you to have to work your few employees overtime, you end up paying more per person because you have to pay them overtime pay. And so you often will have this overtime pay problem, which comes out in the price variance. Depending on the company, some companies will actually parse out overtime as a separate variance, but often it's just lumped in as direct labor pay. Also, I like this point that these points that I picked out here. Maybe you have multiple workers working on it, and for some reason this particular period required more of the highly skilled worker's time than the lower skilled worker's time, and so the mix of worker that you have has perhaps a higher price to his or her time on average. Also, perhaps benefits have shot up. Perhaps there's some sort of a government involvement in healthcare, which inevitably increases the price of that healthcare, or there's some maybe the industry as a whole has adopted a certain kind of fringe benefit, and now you're expected to pay for that as well. Perhaps there are union things that have union negotiations that have taken place in which that this has increased the benefits that are required. So the price per direct labor hour has increased some way. Doesn't take a lot of work for you to do some investigation and figure out what is the action you should take, if any, to rectify this, if possible. Often involving HR or involving management, sometimes involving the person on the factory floor who is scheduling these kinds of things. Again, if you're having some trouble with overtime pay, perhaps maybe we need to plan out our time better so that we get out those Gantt charts and stage our work in a more efficient manner, so we're not constantly having to do overtime at the end of the period or at the end of right before delivery time, for example. Let's go ahead and do a quick example about the direct labor price variance now. We're going to go ahead and write it down here, since we already said we were doing the quantity variance up here. I'm going to reorganize this a little bit, make it a little bit more like I would write it on the board in a class. I do indeed usually start with the standard when I'm doing standard quantity here, as expressed per finished goods unit, and then I multiply that out to get the standard quantity, the number that I'm going to use. SQ is the total standard quantity I'd expect given the actual volume. And I usually write the whole fact pattern up here. So let's go ahead and just say we had a favorable price variance. We only paid $20 per hour on average per direct labor hour. And so we're going to go ahead and calculate that out. I'll go ahead and copy this down and modify it to make it our price variance equation. So we already know it's going to be favorable because, like I said, we're comparing the actual price we paid per direct labor hour to the standard price or budgeted price of $25 per direct labor. So we paid less. That's favorable for the company. Okay, we can go ahead and incorporate that into our equation formula here. We have actual price minus the standard price, and we'll put the parentheses in here. All that times the actual quantity, because we moved from standard quantity to actual quantity in the previous variance from here, and we're going to create another little peak right here, and we're going to move from this actual quantity standard price over to actual quantity actual price. So this is all multiplied by the actual quantity, and so we have $12,500 favorable. You know what? I don't like that. I want it to be one way or the other. I want it to be, I don't want it to come out so nice. Okay, let's make it a little bit more favorable. So now it's a $7 difference per labor hour as far as our favorable price savings. And that leads to, in the end, a $17,500 favorable variance here. We can also, like I was drawing with my cursor there, look at the actual amount. We have an actual price we spent times the actual quantity we consumed. And so overall, we knew from the get-go that we had a $5,000 total budget variance, favorable total budget variance between our flexible budget and our actual budget. We just didn't know that in there was this inefficiency. So here's our price variance, and it's this minus this. So it's a so now, yeah, we have the two peaks that we usually look for, little pyramids here. And so the story is a little more complex than you might think if you just looked at the budgeted numbers, the flexible budget, what we would expect given $1,000 volume, and what we actually paid for direct labor. We'd say, oh, we saved $5,000. Well, why? Well, we saved $5,000 because we paid much less per employee than we expected to. And what most likely is happening is we're buying labor cheaper, less experienced labor, or somehow labor that doesn't have the same skill set as we expected. And we are saving because of that. Now, we have an offsetting unfavorable variance right here in quantity because that less skilled set of laborers is not doing as good of a job with there we go, the actual quantity of labor hours they required in order to complete 1,000 finished goods is much higher than we expected given the flexible budget. And so we saved money on them, but they were less efficient. It ended up being a net benefit for us. We saved more money on them than they lost us in their inefficiency between here and here. But it didn't have to turn out that way. And so this gives us an idea as to what we can look at for the next period. Perhaps this is a winning bargain for us. Perhaps this is an unusual period for us. Perhaps this gives us information on whether or not where on the curve we are between efficiency and savings in terms of labor price. Now, as far as the direct labor variance journal entry, as promised, traditional variance analysis in terms of the direct labor, direct materials, and overhead variances can all be done automatically within the T accounts and within the journal entries in the accounting system. This makes it much more automatic and produces variances that are easier for companies to use immediately. So the way that we do this is that when we're entering the journal entries, we're going to go ahead and include the variances in the journal entry. We have accounts, variance accounts, variance T accounts are expense accounts. They're a special type of expense account, and you're going to debit or credit them based on the variance. And so we'll talk about that here in a second. But the basic idea is you're going to have one side of the journal entry that is at actual cost, or at least a more actual cost, and one side that is at a standard cost. And then in the middle, the plug between the two is going to be your numbers that go to the variance accounts. And so in the case of direct labor, obviously you want the expenses, the wage expense, to be at actual cost. Yeah, they frown on you not recording your expenses and concordantly your liabilities at actual cost. Just ask the Enron people about that. You can get sent to prison for not recording expense accounts and your liability accounts is at actual values. So yeah, of the two, that has to be the one that's at actual. And typically, the different companies can run this differently, so that's why I put the typically qualifier in there. Typically, what you'll do if you're doing standard costing is your WIP account will be at full standard. So it's at standard cost, as a standard price and standard quantity. So, or given the number of units we worked on this period, what would be the standard price and the standard quantity of inputs that we would have put in there? And we're going to charge that to WIP. And then, if we used more units based on the quantity variance, we will charge that cost, the quantity variance, to our direct labor quantity variance account. And based on how much more the actual price was than the standard price, we will charge that to the price variance account. Now in this case, look, the actual amount is higher than the standard amount. And so these are both unfavorable variances. Variance accounts are expense accounts, and they are more expense with a debit. They go up with a debit. And so if you have an unfavorable variance, it's going to be debited to the variance account. If you had a favorable variance, it would be credited to the variance account. I hinted at earlier what I express in this rule of thumb here, that I'm covering a full version of standard cost that records WIP completely at standard. And so we're talking about, given the units that we produced or worked on, what is their standard price and standard quantity, multiplies it together, and that's what we're going to end up debiting to WIP. Now what you debit to WIP eventually gets credited once those work in process units are complete, and moves over to finished goods at standard. And then from finished goods, once they're sold, moves over to cost of goods sold at standard. So in a full standard system, your cost of goods sold is expressed completely at standard. And you've taken out these variances along the way because you want to measure them separately. They're not really the cost of goods sold based on the standard system. They're a management tool. We deviated from the standard that we would have expected, and so as a result, we have these separate numbers that we're going to use that are elsewhere on the income statement. We'll talk a little more about that in Chapter 8. But yeah, this is the idea. We have a wages payable we have to record at actual. They frown on you not recording that at actual. And you debit the wage expense once that happens. But then you turn around and you credit the wage expense. So wage expense ends up being this flow through where it gets debited and then credited out. And likely this will have a different coding in your ERP, so that if you wanted to, you could just look at this number, the debits to your expense accounts without the flow through amounts, to figure out the total amount of expense if you really were looking for that number. But at the end of the period, this is already zero. It ends up being zero because we passed through all the wage expense through to one. The standard amount of it has gone to WIP, and then the two variance amounts have gone to the separate expense categories. And again, remember that expense accounts for cost variance anyways the variance accounts for costs are expenses, and so you debit these accounts for unfavorable and you credit them for favorable. I hope that is intuitive enough, because expenses are bad, and so if it's unfavorable, you're going to use it like a normal expense account and increase it with a debit. If it's favorable, then you do this kind of backwards thing where you credit an expense account. Let's finish our example here, and it's actually simpler than you might think. You can just take, if you create the pyramids, you could take this box right here, this box right here, this box right here, and this box right here. Just one gets left out. Just these four right here, and you end up with the four pieces of the direct labor variance entry. Okay, so we're going to be debiting WIP. We're adding to an inventory account here, WIP inventory account. We're adding to the direct labor piece that we exerted on work that was completed work that we did this period. Some of it was completed, but that's a separate issue, a separate entry. So we debited a certain amount to WIP at standard. So we're going to go ahead and debit $50,000 to WIP. We know that at the bottom of the account we're going to be crediting the wages expense. And so this is at actual. And now we're going to have a debit and a credit to our two variance accounts. We have an unfavorable quantity variance. So unfavorable, it's going to act like the variance accounts do as an expense account, and increase with a debit. And so it's going to increase there, and then we're going to credit our DL price variance account by this amount right here. This perhaps helped illustrate why I say you're gonna at some point get these into absolute values, because there's no such thing as a negative journal entry. You have either a positive debit entry or positive credit entry. The debits versus credits takes care of the polarity of signs, of the sign of the number, just inherently. So here is our balanced account now. Look, we have a total of $62,500 over on the credit side. Our balanced journal entry, I should say, not balanced account. And we have $62,500 over here on the debit side. And that would be our direct labor variance recording entry, similar to number 2 in the example in the textbook. Now again, this happens all at once. We know how much direct labor hour usage we had, the actual direct labor hours. We know the actual direct labor price, and we know, of course, the standard of both of those as well, quantity and price, at the moment that the time period has elapsed. And so we can recognize all the variances at once. Direct materials is not so. This is why I make a big point of saying, we can do it all at once, because the direct materials is different. So let's talk about the direct materials variances for a second. So there's a difference here, and the difference is that direct materials variance has two different definitions of actual DM units, actual units. The actual quantity here could either be the actual quantity purchased or the actual quantity used. And this is because direct materials get bought and they sit in a warehouse for a while. You don't do that with direct labor. That's considered kidnapping, and it's frowned upon as well. So with direct materials, though, we buy them in one period, or we buy them at a certain point, and they often sit in a warehouse for a while before they get put into use on the factory floor. And so they're in this other inventory account called raw materials, often called raw materials. Sometimes it's just called direct materials, which reflects the value of inventory in the warehouse that hasn't been yet used on the factory floor. So we have an actual quantity that we purchased that went into the warehouse, and then we have an actual quantity that we used, which means it's coming out of the warehouse and going onto the factory floor. Those don't have to be the same. Some of our direct material value is being stored at the warehouse, and that value goes up and down based on the difference between these two right here. The purpose of variance analysis is to assign responsibility and to figure out what the action plan is. And often it's two separate managers, two separate departments that are making the choices between actual quantity purchased and actual quantity used. You often have a purchasing manager or procurement department that is deciding how many units to purchase and how well to keep stocked the warehouse. They're managing that side of the company. And then you have, on another side, the production manager, who is deciding how to take them out of the warehouse and how well they're used, or making some decisions that affect anyway how efficiently those materials are used on the factory floor. You don't want your managers to be able to point the fingers at each other and say, no, it was the purchasing manager's fault that my actual quantity is so high. And so when we're talking about quantity variance, we're going to use the actual quantity used so that we can pinpoint how much the responsibility is on the production manager who oversees the factory and how the factory floor works. And when we're talking about price variance, we're going to use actual quantity purchased because we want to assign responsibility for what was done by the purchasing manager. So what this also means is that direct materials often doesn't line up as perfectly as you'd like. So if you lined up everything like in direct labor here, this balances perfectly. It's not going to be quite as neat and tidy with direct materials, assuming they make this distinction between purchased and used. So let's talk about this real quick. Quantity variance. In the version we're going to talk about in this textbook anyway, we have actual quantity used times the budgeted price, which is standard price, minus the budgeted quantity used, which is the standard quantity, times the budgeted price. Algebraically, we can rearrange that, and we're just varying here the actual quantity used in these two instances. We're just varying the quantity used, either actual versus budgeted, and we're multiplying it by standard price. Now, sometimes this is called the efficiency or usage variance. Doesn't matter. Quantity variance, it works the same. Now, an unfavorable variance suggests that something is happening that is making you be inefficient with these direct materials that are being brought onto the factory floor. So this could be tied in with your direct labor. If your direct labor is not skilled, they might have extra waste. If your machinery is out of date, so now we're talking about maybe an overhead cost more. If your machinery is out of date or poorly maintained, it could also mean that you're wasting more materials. You might just have poorer quality of materials. But with a little investigative effort, the firm can figure out an action plan to improve this variance or to maintain a favorable variance. All right, let's go ahead and just keep working on our example here. We're going to go ahead and create a new sheet. I'm going to start with our quantity variance. And then further down, we'll go ahead and get our price variance. And I'll just write in the whole fact pattern up here. We have AQU, AQP, actual quantity used, and actual quantity purchased. I think I'll reverse those. We have the actual price, and we have standard quantity and standard price. So we're going to have now 5 items in the fact pattern. Let's just go ahead and say we have some. All these numbers are for one type of direct material. For simplicity, we're just going to do one. You end up having these variances for all sorts of direct materials. Every direct material that gets used can have a set of variances like this. So we're just going to go ahead and say we purchased 5,000 units. We went ahead and used 4,500 of those. The price of those units was $10 per unit. We'll go ahead and get some labeling here. Aha, see, that's critical that I do that right there. Clarify what the units that we're talking about are. Our standard quantity of units. All right, so we produced, back here, we produced 1,000 finished goods units, and we have 5,000. Let's just say that the standard is to use 4.5 DM units per, no, 4 DM units per finished goods unit. Okay, and so therefore we have this standard quantity per finished goods unit times our actual finished goods units to give us the SQ that we're going to use of 4,000. Our standard price, let's go ahead and say it was at $9. So we have quantity variance here. We're going to calculate that out. We're going to be varying the quantity, and it's the who decides the quantity? The production manager. How much the production manager used. So we want to compare actual quantity used against the standard quantity, and all that times the standard price. Because the quantity variance is on the right hand side of all this, we have the, if you're trying to remember this on a test, for example, quantity variance is over here. You're minding your P's and Q's, price and quantity variance. So quantity variance is on the right here, and therefore it's going to be at a standard price. These are going to hold standard price constant because this is full standard over here, and just vary the quantity. And so yeah, we have this. Now we're going to go ahead and just multiply our units out here, or rather, we're going to first take the difference. Our units used versus what we would expect to have used. We used 5,000 more units than we expected. Is that favorable or unfavorable? That's unfavorable. We used more units than we expected. And that all times the standard price for those units. So we have $4,500 worth of quantity variance. Now we can build our little pyramid over here. I'll build it up here. Let's see, I'm a little more organized here on this, in this tab. Price variance. And then quasi-budget, I call it. And then the flexible budget. I'm not even going to worry about the static budget. We already covered the idea that, some sneaky professor is going to include the idea that, oh, you add 4 units per finished good unit, but I gave you the information that you expected last year to only complete 800 finished goods unit. And so one of the answers, I'm sure, will be if you were to multiply this by 800. One of the answers is almost certainly going to be based off of this number right here to try to fish you into using the wrong quantity. Well, we're not going to do that. We're smarter than that. We know what the right amounts are here. Our flexible budget, is standard quantity times standard price. Our quasi budget here is the standard price, the actual quantity used times the standard price. And what we're going to have to do actually is get a little bit of separation in our mountain range. So we still have two peaks in the mountain range, but there's a little valley in between because this is the quasi-budget using actual quantity purchased, and this is the quasi-budget using actual quantity used. And you notice they are not the same here, and so these two numbers are not going to be the same. But for our purposes now, we have this amount minus that amount right there. 4,500 is our variance. So that's our quantity variance. This is an unfavorable variance. We already said that. We used more than we would have expected to use. And by the way, that fits very well with our inefficiency from having cheaper labor in the prior examples. Now with direct materials price variance, again, we're going to use the purchased amount, the actual quantity purchased. We're holding that constant between the two, okay? Because it's a price variance. We're not interested in varying the actual quantity. We are interested in varying the price. We have actual quantity purchased times actual price minus actual quantity purchased times budgeted price. And so we can rearrange that and put in the parentheses actual price minus budgeted price, all times actual quantity purchased. Now, an unfavorable variance suggests there's some sort of a problem or either within the purchasing department or the external market for this input. With a little bit more effort, you can figure out how to do this. Let's finish up our example with the direct materials price variance. So we're going to go ahead and create a new quasi-budget number here for the actual quantity purchased times the standard price. And then we're going to compare that to the actual quantity purchased times the actual price. So notice that actual quantity purchased was held constant between these two, and the difference between these is only going to be possibly attributable to the price difference. So the purchasing manager got us a little bit of a worse deal, at least unfavorable, more cost per unit than you would have expected. $10 was the actual price. $9 per direct materials unit is what we would have expected. And so this is an unfavorable variance. We can go ahead and run this down over here too. Price variance. And we have here something we can copy this down and change it up a little bit just so we can use it for the price variance. We have actual price minus standard price all times the actual quantity purchased. So let's go ahead and run that through. We have actual price minus standard price. I gotta push F2 and put the parentheses in because I always forget to plan that. And all that times the actual quantity purchased. So we have, again, we get same both ways. And this is also unfavorable up here. Okay, now this tells an interesting story, and with a little investigation, perhaps the story goes like this: that the purchasing manager separately thought that they would be able to benefit the company by getting a slightly higher quality of input for this particular direct material input, and so it cost a little bit more. However, because of and so the theory is that would have had an unfavorable price variance, but that would have been an offsetting favorable quantity variance. But if we go back to our direct labor, remember we had the cheaper labor that perhaps was a little less skilled, a little less experienced, and so they had such their downward pressure on the quantity variance was so great that we saw no benefit from having the higher quality direct material that will fall apart less and fail less on the factory floor. They failed so much more that we had still an unfavorable quantity variance. And so we can now separate out this story a little bit and figure out a little more what's going on. And I think I'll talk about this a little bit later, but there's a difference between these two right here. And I don't know exactly where the best place to put it would be, but it's a $4,500 difference. And a lot of people are very bothered by this. They say the total budget variance was $14,000. Look at this. $36,000 what we expected, and $50,000 is what we actually paid for this direct materials input. And yet, we only have $9,500 of that accounted for in our two variances. Well, that's because you have a bunch of value sitting here in your direct materials inventory account right there. Yeah, we bought 5,000 units. So there's 500 more units that were bought at this higher price that are here in the direct materials inventory account that haven't yet been used. Next period they'll get used. They'll be put out onto the factory floor where the quantity variance is going to happen. So that's where that difference is. And if you add all these together, you end up with a $14,000 difference. So yeah, direct materials inventory increased by $4,500, the value of that inventory account, because of the 500 direct materials units at $10 per. At 500 direct materials units at $9, the standard cost per direct material units. And that's accounting for the difference between these two. So this doesn't get recorded in the variances, but it's there. So don't get frustrated by the fact that the total budget variance is not accounted for by the two variances that you're going to pull out and work with. The other inventory account is accounting for the rest of the difference. Now, with the direct materials journal entries, when you have this embedded in the accounting system, in the T accounts, you're going to have some differences between this set of entries and the direct labor set of entries. First of all, they're going to happen at two different times. One entry is going to record the price variance at the time that units are purchased, because that's when you know AQP, actual quantity purchased. The other entry is going to happen when units are used, because when you know AQU, actual quantity used. So you're going to have two sets of 3-line journal entries. Let's go here. Yeah, we have a set right here for the price variance, and we have a set right here for the quantity variance. Now let's run through this in detail here. So let's say, for example, we have so each of these lines in the journal entry is corresponding to a block in our little diagram. Well, all the way up here. There we go. So we're recording the price variance first, and we have an actuals right here, a price variance, and a quasi-budget, which is the actual quantity of the direct materials used, actual quantity purchased times the budgeted price, times the standard price. Okay, and that corresponds directly with our 3 areas of the journal entry. Our accounts payable is the actual amount we owe for the purchase, the actual cost of the purchase, $1,000. Yeah, you've got to record that at actual. Again, don't you know it's frowned upon. It's a dumb joke, and I repeat it over and over, but I think it helps you remember the liabilities, the things that actually touch the balance sheet and income statement, or that are more directly touch the balance sheet and income statement. These have to be recorded at actual value. They frown upon you recording how much you owe at a different amount than how much you actually owe. So that's the actual $1,000. We have how much we would have paid if it were at the standard price. So again, this is at full actual quantity purchased times the actual price, and this is the actual quantity purchased, but at the standard price. Actual standard. And the difference between those two is unfavorable in this case. We paid $200 more in actuality than we would have budgeted given our standard for price. And so we have a $200 direct material price variance. That's this example right here. We have 10 ounces of rare earth metal for $100 per ounce. That means we paid $1,000. We would think we'd only pay $80 per ounce. That's our standard. And so 80 times 10 would give us the 800 that we're going to record in direct materials or raw materials. This is the amount reflecting in the value in the warehouse once we purchase it. And the difference is 100 minus 80, $20 per ounce, times 10 ounces, 200. So we're just doing the price variance right here. Actual price 100 minus 80 gives us $20 from the parentheses here, times the actual quantity purchased, which is 100. That gives us a price variance of $200. It's a debit because it's unfavorable. Variance accounts are expense accounts. They go up. Your expenses going up is unfavorable. They go up with a debit. So unfavorable variances are debits to your variance accounts. Now for the quantity variance, these take place, you're going to record these when the production manager takes units from the warehouse and puts them into production on the floor. Now, remember the rationale we used for our direct materials account here? It was a quasi-budget, which had standard price and actual quantity purchased. We're going to keep that. That inventory account maintains that rationale. It's going to have actual quantity used, in this case, times standard price. And so the amount that we're going to credit to it when units are taken out of the warehouse is the unit actual quantity used, the actual quantity taken out, times the standard price. So we have a kind of a step down from our actual world, which is where our actual debts live, our actual debts and expenses live, down to the warehouse in which these materials are recorded at half at actual, half at standard. They're at a standard price specifically. And then we step down further when we get to WIP, and we record WIP at full standard. That's my rule up here, remember? My rule of thumb up here was that WIP is always at standard. Costs debited to WIP are at standard. And that was true here. Now, there's no step down because, again, it's illegal to store direct labor hours. That's kidnapping. So there's no warehouse in which you store workers. But there is for materials. Okay, we don't have a bill of rights for the materials. They get to be stuffed in a warehouse. They have a step down here from the direct materials account, this credit right here, and this debit right here, which is on a half standard basis, to WIP, which is on a full standard basis. And so, yeah, let's say in this example we're saying that we use the actual quantity used is 7 ounces of rare earth metal, and we're still at standard, so we're going to multiply 7 times 80. The standard price from last example was $80, and we get $560 is the credit to direct materials, the inventory account there for raw materials. Now, for WIP, it's full standard. So we in my example here, I say the standard quantity is 6 ounces. So I don't know exactly what that means. Let's just say that every ounce of rare earth metal is supposed to give us 100 cell phones. Let's say we're a cell phone manufacturer. Well, that's our standard, is 100 cell phones per ounce of direct materials. But to produce 600 cell phones, we actually use 7 ounces of rare earth metal. That's not good. That's inefficiency. And so we are going to multiply the standard amount, 6, times the standard price, 80, and debit that amount to WIP, and take the difference between these two and debit it to our quantity variance. Again, it's an unfavorable variance because our standard amount is less than our quantity amount, and we're talking about costs. Our more actual amount, our more standard amount is less than our more actual amount. And so we have a quantity variance that's unfavorable. That means it's a debit to this quantity variance account. We have the two accounts lined up like this, or two entries lined up like this. They happen at different times. They can't happen at different times anyway, and they don't have to line up. Notice how we debited $800 of actual quantity purchased times the standard price to direct materials here, and we only credited $560 for the 7 ounces times standard price of $80 that was taken out and used. And so there is, as a result of that, $240 of residual value left in the direct materials account, at least $240 more in the direct materials account. That reflects the extra 3 ounces at $80 per ounce that we bought but did not use this period. So this is the direct materials account. If we got the ending trial balance of this would be $240 credit, excuse me, a $240 debit, which reflects the value of those units. WIP is at full standard, $480, and we have our variance accounts, both of them unfavorable in this case. The biggest unfavorability was our price variance because we paid $100 per unit instead of $80, and we bought 10 units. So it's $20 price difference times 10 units equals $200. And so there are our material variances. They don't line up as neatly. Your full standard here plus the variances of 280 does not necessarily equal the actual, because some of the value is stuck in direct materials because of this difference right here. But each entry on its own does balance. Just the two entries together don't make a mega entry like this right here. Direct labor balances all together, all the variances and the standard and the actual together balance, and it's nice and neat and happy and just kumbaya. But with direct materials, doesn't work that way. At least as long as we're going to make a distinction between actual quantity purchased and actual quantity used, and if those two values are different. All right, for sake of completeness, let's go ahead and finish up the journal entries for these right here. We get to use all the boxes that we made. These 3 are our lines in the journal entry when we purchased the DM units, and these 3 are the lines in the journal entry when we use those units in production. So we have a debit to direct materials when we purchase, and we have an unfavorable variance, so we're going to be debiting the DM price variance account by this amount right here. And then we are going to be crediting, crediting our accounts payable, assuming we bought them on account. It could be crediting cash, but it's at the actual amount. You got to record your debts or your cash amounts at actuals. And so we're going to have a similar journal entry because it's unfavorable up here as well. Very similar journal entry down here. I say I want to make sure it's unfavorable because then I don't have to move this over to the credit side. I need to change a bunch of names because we're actually debiting WIP, and we're crediting our DM, which again is an inventory account. And we're going to be debiting, in this case, our quantity variance. And we're only debiting it because it is an unfavorable variance. Full standard is our WIP debit. The quantity variance is our quantity variance debit, and then we have this quasi-budget amount that uses the actual quantity used right here. So at standard price but actual quantity used, we're going to be crediting direct materials in that way. And so the DM account, let's assume that the T account had had a zero beginning balance. We debited to it $4,500, right? $45,000, excuse me, right here. And then we credited to it, make the cells work, use Excel, to its full potential. We credited to it $4,500. And so if we took the trial balance now, we would end up with that difference of $4,500. So that's going to bridge the gap between these two amounts right here. Now, on to the overhead variances. Let's jump through these as quickly as we can because I want to get to those mix and yield variances before this video gets to be, Lord of the Rings length. With variable overhead variances, we can divide our overhead into our variable and fixed overhead. We can take our variable overhead, which varies with volume, and we can treat it largely like kind of like direct labor. Some differences, but just stick with that analogy for now. And then our fixed overhead is going to have a very different paradigm that throws some people off, but we'll go through as succinctly as possible to that too. So we're going to divide up if we have a PDOH for if we're in a job order costing system, or a series of, this works as well if we have a series of activity rates in activity-based costing system, or if after the fact we have a series of direct materials cost rates per equivalent unit in a process costing system, or whatever the case may be. It'd be a conversion cost rate. We can pull a very similar sort of technique with any of those situations. But we're going to go ahead and pull apart the variable overhead out of the PDOH. The PDOH is calculated by total overhead divided by total budgeted cost driver, and you determine which parts of your overhead are variable, and then you just divide. You have that be the only thing in the numerator. So you have total variable overhead over total cost driver, and that's what you would be using for your PDVOH in this case. And that is basically the price that you charge for your variable overhead. And you're going to have your variable overhead variances set up very similarly to the two categories we talked about before, especially the direct labor category, similar to that. We have our actual quantity times our price, basically, for variable overhead, predetermined variable overhead rate, minus our budgeted cost driver used times the standard price for PDVOH. Now, cost driver is basically the quantity that drives the overhead that we apply, and so that's basically the quantity used for overhead. Is it exactly right? No. That's one of the reasons I have the little note up here that says there are some limitations to the usefulness of overhead overhead variances. Because what if the cost driver doesn't fit very well? What if it doesn't? There are lots of things that it's missing in terms of overhead being overhead responsibility. Then we have a far less informative number with our variable overhead variances. Okay, but regardless, this is the cost driver that gets consumed is our quantity of variable overhead effectively times whatever the rate is. Okay, so with this we again are just varying the quantity between actual and budgeted, and we're to multiply that by our price. In this case, a standard price of PDVOH. Now, for price, we again have PDVOH right over here. That's our standard price, basically, multiplied by, I'm on the right-hand side of the equation here, going backwards through, times our actual quantity, actual cost driver consumed is our quantity of variable overhead consumed effectively. And here we're going to have to calculate actual variable overhead rate. We're going to have to take the actual variable overhead costs and redivide those at the end of the period here with over the cost driver. So we have our actual rate. If we knew after the fact what this would be, and then we have the actual quantity again. So the difference here is between these two right here, our actual VOH rate and our variable overhead. And so the difference in price and then the actual quantity. Again, I'm not gonna be too picky about this. There are people who live and die by the overhead variances, and I think they can, in some circumstances, provide useful information. It's going to be company to company, though, because some of these relationships are very loose. And, like we talked about in video 7-1, you really want to be isolating the variables that are varying between your two groups of comparison, and overhead variances generally don't do that very well. Specifically, the variable overhead variance here, it's hard to interpret the meaning, harder to interpret the meaning, and harder to nail down responsibility, which is the purpose of variance analysis. With fixed overhead variances, okay, we're gonna parse things out a little bit differently, because because they don't vary by volume. That kind of defeats one of the big things that we're using in our peaks up here. Fixed costs don't vary by volume. There it is, all the way up there. Okay, they don't vary by volume, and so our actual quantity of the actual cost of our fixed cost is likely to be very similar in these three numbers here. And so we're gonna need to have a different paradigm of what we're getting out of our fixed overhead variances. This is one way that companies do it. There are a couple different ways they do it. I covered just this one way. We kind of change it, and we take our actuals and we stretch all. I made this a wider peak on purpose because we're going from actuals to all the way over to static budget, and that's a big jump. We usually would have quasi budget. I've called it in the past in this chapter right here, and we'd have flexible budget right here to get a price variance, a quantity variance, and then a volume variance. But we're just going to take a whole thing and call it the spending variance. So we had a budget for our fixed overhead costs, and we have the actual amount of fixed overhead costs we spent, and we basically just take that one variance. And that, you would think that would explain everything about fixed overhead. It doesn't. Unfortunately, it doesn't. Because there's another factor that happens. When you are absorbing overhead costs into product units, you are applying those costs based on consumption of an overhead driver. And so as a result of that, some of those costs are going to be applied more than you were budgeting or more than is actual. So you have a different thing over here, applied cost, to get from the amount on the books to your static budget. Now, this volume variance is roughly equivalent to the portion of your over-applied overhead back from chapter 4 that was due to fixed overhead. Over or under-applied. That's basically what this volume variance here is saying. We over-applied costs or we under-applied costs from what we should have. What we were expecting based on the static budget. I spread them out like this on purpose. I've gone back and forth about this, and I referenced a few other textbooks, and this is the best way to explain what we're doing with our fixed overhead. Okay, so we have two variances, the spending variance right here. We have actual fixed overhead costs minus the static budget fixed overhead costs. And then we're going to hold constant our predetermined fixed overhead rate for our volume variance here, just to compare these two. And just have our differing there, the what we expected the cost driver to be and what the actual cost driver was. So the volume variance here is going from what we have on the books, the fixed overhead cost that was applied. This is this part in front of to the left of the minus sign, getting us to the static budget amount we expected to be applied right here. So then we can compare that static budget to what actually happened. The idea being that this is an artificial artifact. This is an artifact of us over or under applying fixed overhead costs. This is going to be varying based on the accuracy or inaccuracy of our estimation of the cost driver, and not really about whether we're managing our fixed overhead costs well enough. So we want to parse that out first so we can get the spending variance, which is the big deal. That's really what we want to have, and that's going to get most of our mileage for fixed overhead variances. We're going to get this great illustration, a couple of them here, talking about how to put together a costing system, the different questions that are answered by the different systems that you have. So typically, we've been going over right here primarily the chapters 4, 5, and 6 right here. Cost accumulation method, and here we're talking about at what level we're accumulating costs. Job order, process. We'll talk actually about backflush in chapter 8. And then hybrid is any system that uses a mixture. Oftentimes, companies will mix these two together, and if for the portions of their work that is in a process and all jobs or orders get the same kind of treatment, they'll use a sort of process costing for that. And then when the part of the jobs and orders that are customized and vary, they'll use job order. Often you'll see conversion costs on a process costing paradigm, and then they trace direct materials to individual job orders, for example, if you're using a hybrid of some kind. So cost accumulation method is often what we're talking about when people are asking about costing method. The answer to one of the questions that a cost accounting system answers. We also have inventory valuation method, and the reason it's over here and not over here is, remember when we went over chapter 5, I said that sometimes activity-based costing, so the reason why activity-based costing is over here, I said that sometimes activity-based costing is pulls in SG&A costs, and so you have a different mentality of how you're valuing the inventory. What is considered a product cost or an inventory cost? Some of the SG&A costs get pulled into inventory as a result of that. Most of these right here are using full absorption. That's the traditional setup, and that is in fact what's required by GAAP, full absorption. The idea that everything that is a product cost should be absorbed, either directly traced or absorbed through some sort of a overhead rate into individual product units. That's how you need to that's how you need to value your inventory. That's required for GAAP. Activity-based costing is not compliant. Neither are either of these methods, which we'll talk about in chapter 8. Now, over here, input measurement basis is what we're talking about when we're in a standard costing system. Because when you are in a standard costing system, you're going to change how you input the numbers. Remember when we talked about just earlier in this video, when you input the journal entries for direct labor and direct materials, we have different journal entries. We input the measures of our costs on a different basis. We're going to value our inventory. We're going to input the measures of our inventory at full standard when it gets to WIP, and therefore downstream to finished goods and cost of goods sold, it'll be full standard, unless you do some sort of adding back in of the variances at some point, which I don't think you would typically do. So here we have our full standard. Now, when we went through chapter 4, I was actually describing to you the normal historical method. All that stuff with the overhead control account and how you would take the overhead and determine how much of it is over-applied and under-applied. That's the traditional normal historical method. I think I have a different link here which shows this illustration. Nope. Here we go. So a pure historical look says we want actuals of all our different types of product costs to go into inventory. Our actual direct materials costs, our actual direct labor, and our actual factory overhead. When I got to chapter 4, I taught this way. We are going to take actual direct labor and direct materials, but then overhead is going to get applied, and there's going to be a variance right here. The over or under applied overhead control account holds on to this variance. And then at the end of the period, you either move it to the different inventory accounts and COGS, or you just move it directly to COGS. In standard costing, our journal entries are allowing us to do the same idea. We're applying direct material, direct labor, and factory overhead at a standard basis to WIP, and we're accumulating the variances in these other pools, these other accounts, which allow us to then measure those and make decisions based off of those. And so that's answering a different question of when we input our dollar measures of cost. Are we using pure actuals, pure historical? Are we doing just actuals for the direct costs and taking the indirect overhead costs and using an applied basis, which is the traditional? Or are we going full standard to get all the variance information that we can to then use that for decision making? So we in chapter 4 we went over this, and this. And then chapter 5 we basically did this. I didn't talk that much about it, but that was more or less the assumption. Then we talked about this, and we focused on this because activity-based costing tends to be most useful, in my opinion anyway, with job order costing. It makes the most sense. It theoretically could match with process costing, a backflush system. That wouldn't make any sense, or a hybrid system. They go in opposite directions. Activity-based costing is a complexifying of your costing to become more accurate. Backflush is a simplifying of your system to be more efficient. So you would never combine those two. This chapter we've gone over how we would input actuals and variances differently. We record them in the very journal entries that we use to recognize cost. And then in the next chapter we'll go over somewhat more of the actuals. That's one of the assumptions of lean accounting. Go over these two different inventory methodology evaluations, the backflush cost accumulation method, which coincides with a periodic recording interval. So, mix and yield variances. The idea is that we have a mix of different ingredients that are substitutable. So with revenue, we might have a mix of product 1 versus product 2, product 1 premium versus product 1 basic, product 2 brick and mortar sales versus product 2 internet sales, etc. We have different ways of selling, different streams of selling, different products of selling, and we're going to have a mixture of those in our revenue number, our total budgeted revenue number, specifically in our quantity variance, our revenue quantity variance, or sales quantity variance. And in direct labor, you might have a mix of highly skilled or lower skilled workers. You might have permanent workers versus contractors. You might have regular hours versus overtime hours, etc. There are a number of things that can go into the mix of your quantity variance that can move the price up or down based simply on the mix. The same number of hours might be incurred, but because the mixture was higher in, say, high-skilled workers or more overtime or more contractors, the cost was higher. And so we're going to tease that out with the mix variance. In direct materials quantity, we might have multiple chemicals that go into a mix, multiple ingredients that go into a bag of let's say, a trail mix is a great example, to multiple, different types of nuts and candies that go into a trail mix, and different inputs in terms of quality that might be different levels of quality. And depending on the mixture that we have at the end of the day, we might have the same total poundage or total units of ingredients or total units of the input, but because they're a slightly higher mix of higher quality or a more expensive ingredient or chemical, it could easily be more costly to us, or vice versa. If it's a higher mix of the low quality input, higher percentage of low quality input, low cost ingredient or low cost chemical, then we might have a lower cost due to the mix of direct materials. So what you need to do is you need to take, for each input, the actual input quantity minus the standard input quantity times the standard price. And then you sum those inputs. That's what the sigma here means. That's what this symbol. You do that for each input and you sum them. So what we're doing here is we're varying the quantity of that input. And so, for example, we might have a lot more high-cost ingredients we put in and a lot fewer low-cost ingredients we put in. This will tease that out. We have our high-cost ingredient has an actual input quantity that's higher than its standard input quantity times the price for that ingredient is high. For our low-quality ingredient, low-price ingredient, maybe we have a lower actual quantity than we expected, and the standard price is relatively low. And you add those together, you end up with our mix variance. You can also create a table, which will lay it out a little differently, but get the same end result. So if input 1, the actual total quantity is 1,000 for each. actual mix input 0.5 and 0.5. Standard price of $15 for input 1, so it's the high cost input, and $10 for input 2. Now that actually is a more costly mix than we were expecting. We expected them to come together in a 0.25 to 0.75 or a 1 to 3 mix, not a 1 to 1 mix. So we expected to have 3 times as many unit 2s as we had unit 1s, but that didn't work out. So we end up having this number right here much higher than this number right here. And this number right here is lower than this number right here, but only to a certain amount. We only save so much because this is a lower cost input. So we have, in this table, we have more cost because we had a higher mix of the higher cost input than we would have expected under the standard circumstances, under the standard mix. So notice that it becomes clear in the table, perhaps, what we're varying between the two. We're varying the mix. It's embedded in the equation. It might be a little harder to tease out what we're doing, though, because the standard input quantity is devised by the mix. The idea is that your standard input quantity is going to be calculated by what your standard mix is, times the actual units. You would expect 250 units of that input 1, when actually we got 500. We got 0.5 of 1,000. We got 500. So 250 times the standard price of $15 will be our component that is due to input 1. And input 2, we would expect to have 750, but we actually got 500. So we have negative 250 right here times the standard price of $10. And that will give us the same variance overall. So the difference between these two cells right here gives us 1,250. Unfavorable variance due to mix, just due to the mix that we had in. The same inputs overall, so same total inputs of 1,000, but the mix was different such that it was a higher cost. It leaned towards the higher cost input more than we expected. So yeah, I mean, if you're the consumer, you don't mind this. You get that one special trail mix that has 20 M&Ms instead of just 10, and only has 10 raisins instead of 20 like they were expecting to put in. You're jumping for joy. I mean, quite literally, because you're on a sugar high, right? But the idea is you're happy with this. The company's not happy with this because they're selling these trail mix bags based on this expectation right here that they're going to have a sales mix of this amount. But for some reason, they got mixed wrong, and you have a mix like this. So they're spending more on those costly M&Ms than they expected. So now this is actionable for the company. They can say, aha, we need to fix the sales mix. We need to fix, we must have Lucille Ball working our factory. You know, I love Lucy, the standard classic episode of her eating the chocolate on the conveyor belt. We must have Lucille Ball work in the factory, and so she's screwing up how we're doing the inputs. So you can trace this without much extra effort to a root cause for why the mix is out of whack. Now the yield variance kind of picks up the slack. Okay, it's going to require some definitions, and you have to follow the equation very carefully. But I want you to understand, it's simply catching the rest of the quantity variance that is not expressed in the mix variance. That is the ultimate purpose of the yield variance. All right, let's get down to brass tacks with the yield variance. So the yield variance is the difference between standard finished goods output, given our inputs, and the actual finished goods output, given our inputs. So, we have actual yield, which is the actual finished goods units completed. Actual yield. Standard yield is the finished goods units you'd expect, given total actual inputs at the standard mix. So, that is the standard total output divided by standard total input times the total actual input. So fun. What we're trying to do here is say we have a relationship between output to input. We would expect standard total output and standard total input to have this sort of a ratio of output over input. And we're going to multiply that by our total actual input. That will give us our standard yield. That'll give the standard yield given our actual input. Standard price at standard mix is the standard input price for a single finished goods unit, assuming the inputs are at standard mix and standard price. So that is the standard price of a batch of input units at standard mix divided by the number of finished goods units per batch. So usually we're talking about, with these kinds of situations, some sort of a mixture. So a batch, you have how many do we expect in the batch of product 1 versus product 2, or different avenues. We often are looking at these in batches because we're using, say, 2 to 1, 4 to 5 as our mix, right? So the standard price of the batch of inputs at a standard mix, that includes, let's say, product 1 is at $10, product 2 is at $20, and we expect it to have a 3 to 1 mix. That's our batch of inputs. And so we have 3 times 10. Product 1 was 3 to 1, right? 3 for product 1, 1 for product 2. Product 1 was $10 times 3 per batch. We're expecting $30 to be the standard price per batch with respect to product 1. Product 2 has $20 price per unit, and we're expecting 1 per batch of that. So we have 20 as the product 2 component, and you add those together. That is your standard price of a batch of input units at the standard mix. You have $50. You have 4 total units, finished goods units in that. And so you have $50 over 4. You end up with $12.50. That would be your standard price at standard mix. Okay, if you will keep those definitions in good standing. If you'll follow the examples and follow the equation, you can get this all right. So let's go to the example here. So we say we have a product with 2 substitutable inputs, A and B. The standard mix is 2 to 3. That is 2 units of input A for every 3 units of input B. That's also going to be the batch. So for every 5 units of input A and B, a finished goods unit is typically produced. So for every batch, 2 to 3, we have 1 finished goods unit produced. Okay, actual standard cost is $5 for a unit of input A and $10 for a unit of input B. So input B is a higher cost per unit than input A. If we were talking about the mix variance, we'd be concerned about that much more than we are now. We're talking about the yield variance now. So let's say the firm used 10,000 units of input A and 16,000 units of input B. Now that's not quite a 2 to 3 mix. We would have 15,000 units of input B if we were doing 2 to 3. So we have a mix variance here if we were doing the mix variance. We produce 5,000 finished goods units. Okay, to find the yield variance, we need to calculate each of the 3 variables that go into that variance equation up here. Okay, actual yield, 5,000 finished goods. It's the easiest of the 3. Hooray! Standard yield requires some calculation. Typically, there's 1 finished good unit per every 5 input units. Okay, we had 26,000 input units. Okay, we just added together total input units here. Don't go crazy. It's just that simple. 26,000 total input units. Therefore, we would expect 5,200 finished goods units. Again, we expect each standard output to have 5 standard inputs times the 26,000 actual inputs gives us 5,200. Again, we're building a ratio of output to input. We multiply that by our actual input to give us what we would expect to be our actual output, our standard yield. Given that we put in 26,000 input units, we would expect to get 5,200 finished goods units out. So, for simplicity, we'll assume a batch is 1 finished goods unit, which takes 2 units of input A and 3 units of input B. You get to set the most useful batch that you want when you're doing this calculation. Make it simple on yourself. So we have, because we're going to need that for the price, right? We're going to need that for this price. Oh wait, here we go. So we lead to a standard price, at least to a standard price of $40. We have in this batch 2 units of input A, which is $5 per unit. So that's $10 right there in the highlighted section. Plus $30 right here in this section, this highlighted section. 3 units of input B times $10 per input unit B gives us $10 plus $30 equals $40. So now our variance, our yield variance is $8,000 unfavorable. We have 5,000 actual yield minus 5,200 standard yield, all times $40 of standard price per output unit. And here it is set up in a table. We have our actual yield. Our standard yield is simply the actual inputs all summed together. We don't, for the yield variance, we don't care that this is out of whack. This is not 2 to 3. It would be 10,000 to 15,000 if it were 2 to 3. We didn't quite get there. But that difference is going to be accounted for in the mix variance some other place, some other worksheet or whatever. The yield variance, we just sum them together, we get total inputs. We would expect finished goods units to input unit ratio to be 0.2, 1 over 5. Our standard yield is total inputs times that expectation, or 5,200. We would expect, given 26,000 total inputs of both A and B together, to get 5,200 finished goods. And we construct the price per finished good, and we just multiply that by the $200 difference between, 200 unit difference, between these two cells right here. A2 and A16, the difference is 200. That's the difference inside the parentheses right here. Multiply that by the $40 per unit, and we get $8,000. And it's unfavorable. Why is it unfavorable? Okay, this is one of the ways in which my way of doing it is superior to the people who are fixated on the signs. Because I am in the practice of figuring out at all times, just based on logic or the overall context, whether it's favorable or unfavorable. It all comes down to this right here. We would expect, given 26,000 units of input, 5,200 to be our yield. We only got 5,000. That's not good. That's unfavorable. That means somehow we were being inefficient with the total units of input A and B. We've accounted for the fact that we didn't have the right mix. We had a different mix of A and B. We had actually a more expensive mix because B is the more expensive unit. So we had slightly more unit B than input B than we expected based on our mix. But that's all going to be accounted for with the mix variance. This is based on the fact that we put in total units A and B 2,600 units. We should have gotten out 5,200 finished goods. We didn't. So we had some inefficiency there. It may or may not be due to the mix. Maybe A and B maybe there are chemicals that don't combine effectively if they're not in the right mix. And so we had a bunch of precipitate that we weren't able to use. Now, maybe that's the case. I don't know. But often it's not the case. Often it's something entirely separate. It's more along the traditional quantity variance lines, where you say, hey, we have a problem here. We are being inefficient with our units. Perhaps it's because our direct laborers are not as well trained as they should be. Perhaps it's because we're using lower quality units than we should be. Whatever the case may be, somehow it's more the traditional quantity variance explanations when we're talking about yield variance. And that's what I have for mix and yield variance. If you can go step by step and look carefully at the different terms here, build a table if it helps you. You can get through these, and they're not too crazy. But be precise, label well, and keep in mind where they fit in. Sometimes I get people who try to get mix and yield to split up a price variance. That's wrong. That's just wrong. No, the mix and the yield are subdivisions of your quantity variance. They're going to live in this land right here. It's like we have 2 extra peaks right here. One for mix, one for yield. And that's all I have. Bye.